You've seen them, right? Those trading strategies with a performance chart that just looks like a rocket ship heading straight for the moon. It's impressive, but it often feels a little too good to be true. And you know what? It usually is, because the most important information, the stuff about real risk, about reliability, it's almost always hidden just beneath the surface. So today, let's pull back the curtain and give you the tools to see the whole picture. Okay, first, just a quick disclaimer. This is for educational purposes only, and it is absolutely not investment advice. Trading involves a very real, substantial risk of loss, and it's so important to remember that past performance doesn't tell you a thing about future results. All right, here's our game plan. We're going to start with the performance trap, why those perfect charts can be so deceptive. Then we'll talk about evaluating the evidence behind any claims, dig into the metrics that actually matter, learn how to spot some common red flags, and finally wrap it all up with a smarter path forward. So let's kick things off with the performance trap. It is so easy to get wowed by a huge return percentage or a super smooth, perfect-looking equity curve that these headline stats, they're designed to grab your attention, and more often than not, they hide what's really going on with the risk. So when you see one of those amazing charts, the real story is what they're not showing you. They don't talk about the hidden risks or the totally unrealistic assumptions that are baked into the simulation, and they almost never factor in real-world costs like commissions and slippage, that tiny but critical difference between the price you think you'll bet and the price you actually get. And the biggest trap of all, something called overfitting, which is when a strategy is so perfectly tuned to old data that it just falls apart in the real world. So how do we cut through all that noise? Well, we need a simple framework, a way to judge the quality of the evidence someone is showing you. Because not all performance data is created equal, not even close, and knowing the difference is absolutely critical. I want you to think of it like this, the evidence quality ladder. Down at the very bottom, the weakest one of evidence is a simple backtest. That's just a simulation on historical data. One step up is a forward test, which is basically paper trading in real time. That's better. Even better is live trading with a real account and real money on the line. But the gold standard, the very top of the ladder, is third-party verified results, where an independent company audits and confirms the live performance. The higher you can climb on this ladder, the more trustworthy the results are. Okay, now even if you have what seems like good evidence, every single performance report is built on a pile of assumptions. Your job is to be the detective and ask the most important question. What hidden assumptions are making these results look this good? Here is your quick-fire checklist. Are commissions and fees included? Is slippage accounted for? How much leverage is being used? Because that magnifies everything, wins and losses. Is that amount of leverage realistic for you? What's the instrument being traded and when? And what about the data itself? Was it clean, high-quality data? The answers to these questions can totally change whether a strategy is profitable or not. Okay, let's keep going. Now we're going to move past those shiny headline numbers and really focus on the metrics that matter. These are the numbers that reveal a strategy's true character and, more importantly, its real risk profile. First on the list has to be maximum drawdown. Honestly, this is one of the most important metrics, period. It tells you the single biggest drop your account took from its highest point down to its lowest point. It is a measure of pain, pure and simple. And it has two critical partners, how long that drawdown lasted and how long it took to get back to either. And this is where it gets real. A 25% drawdown might not sound terrifying on paper, but look at that time to recovery, 9 months. Now ask yourself, really, could you handle watching your account be underwater for 3/4 of a year before it even clawed its way back to where it started? That's the reality of risk that this number shows you. Next up, let's bust a myth about win rates. Everyone loves a high win rate, right? Look at Strategy X. It wins 90% of the time. Amazing. But the average win is tiny, and the average loss is a killer. Over the long run, this is a losing strategy. Now look at Strategy Y. It only wins 40% of the time, which can feel really tough. But because its wins are so much bigger than its losses, it has a positive expectancy. That's the one that actually makes money. Expectancy tells the true story, not win rate. And finally, there are these risk-adjusted ratios. Now, don't let the names intimidate you. The idea is simple. They just tell you how much bang you're getting for your buck, how much return you get for the amount of risk you take on. The Sharpe ratio is the classic. The Sortino ratio is a little bit smarter. It only looks at the bad volatility. Because let's be honest, no one complains when the account goes up. And the Kalmar ratio, I love this one. It directly compares your return to that maximum drawdown. It's a fantastic measure of return versus pain. All right, now that you're armed with the right metrics, let's talk about what to avoid. We're heading into red flag territory. We're going to talk about that dangerous problem of overfitting and some common patterns you're likely to see out there in the wild. So what in the world is overfitting? Think about it this way. Imagine you make a key that is so incredibly detailed and complex that it only opens one specific old rusty lock. That key is totally useless for any other lock in the world. An overfit strategy is exactly the same. It's been designed so perfectly to fit the random noise of past data that it completely fails the second it faces new live market conditions. It's one of the biggest reasons amazing backtests turn into real-world disasters. So how do you spy it? Well, here are 5 huge warning signs. 1. The equity curve looks too perfect. If it's unnaturally smooth with no bumps, be suspicious. Real trading is bumpy. 2. There's a huge number of complicated rules or settings. 3. It has incredible performance, but only on one single asset. 4. And this is the big one. The performance just falls off a cliff when you test it on new data. And finally, number 5. There's no simple, logical reason for why the strategy should even work in the first place. You should also just be aware of a few common patterns. For instance, you might find that key risk numbers, like that all-important maximum drawdown, are hidden behind a mandatory sales call. You might see selective reporting, where they only show you the best months and kind of forget to mention the worst ones. And a lot of backtests are shown without factoring in realistic costs or slippage, which can make all the difference. Just being aware of these things helps you ask much better questions. Okay, we've talked about the problems, the traps, and the red flags. So now what? Let's bring it all together and talk about the solution. This is about creating a smarter way forward, and we can do it with a simple tool I call the Strategy Scorecard. And here it is, the Strategy Scorecard. It's just a simple checklist that pulls together everything we've just discussed. Before you ever consider a strategy, you can just run it through these 5 questions. What's the quality of the evidence? What assumptions are they making? What's the real risk looking at the drawdown? Is it actually profitable based on its expectancy? And does it show any of those warning signs of being overfit? This little checklist brings so much clarity. You know, that scorecard is really the foundation for a transparent approach. It's about putting the metrics first, making sure the complete scorecard is right there for you to see. No gates, no secrets. It means you shouldn't have to get on a sales call just to find out the maximum drawdown. You should be able to review everything yourself, and most importantly, you should always have full control. And that's really the philosophy we built at Tradescrafter, where you run everything in your own brokerage account. So, what's your next step? Well, now that you have this framework, you can go see what truly transparent reporting looks like in the real world. I want to invite you to take the scorecard we just built together and put it to the test. Go to our strategies page, review the full, completely ungated metrics for yourself, and make your own informed decision. The link is right below. I'll leave you with this last thought. True confidence in trading doesn't come from a perfect backtest or a polished sales pitch. It comes from understanding the complete picture, the good, the bad, and the realistic. Thanks so much for your time.